You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate expert Ian Formigle. Ian is a real estate professional and serial entrepreneur with over 20 years of experience in real estate private equity, equity options trading, and startups. Ian is Vice President of Investments at CrowdStreet, overseeing its marketplace, an online commercial real estate investment platform that has completed nearly 300 offerings totaling some $11 billion of commercial real estate. Ian is also the author of the Comprehensive Guide to Commercial Real Estate Investing, and he is a contributing author at Forbes.com. Now, prior to joining CrowdStreet, Ian was VP of Business Development for Scanlan Kemper Bard Companies, where he managed the firm's alternative investment platform and served as a senior acquisitions officer. Previously, Ian co-founded and served as CEO of Claris Property Ventures, a regional real estate private equity firm that focused on multifamily acquisitions. Now, Ian began his career as an equity options market maker and member of the Pacific Exchange. Ian holds a BA in economics and a BA in political science from the University of California at Berkeley, as well as a Series 7 and Series 63 licenses. Now, here's what you're going to learn in our time with Ian today. You're going to learn how Ian got his start as a multifamily investor and why he chose to focus on Birmingham, Alabama as his target investment market. You're going to learn what Ian would have done differently given the chance to go back in time prior to the crash of 2008. You're going to learn the story behind CrowdStreet and what it looked like being on the ground floor of what is now one of the largest real estate crowdfunding platforms. You're going to learn how CrowdStreet vets its sponsors prior to offerings going live to the general public. You're going to learn the 3 different ways one can invest via the CrowdStreet platform and much, much more. We had a great show together, a great interview, and I think you're going to get a lot of value out of it. Now, real quick before we get on with it, a few things that I want to go through here. Now, I started this last week. This is a new segment that we're going to be doing each and every week where I share my one personal best and my one professional best from the prior week. And so my one personal best, the 4th of July was last week. So first and foremost, I'm incredibly grateful and I'm thankful for all the men and the women that have sacrificed their lives in order to provide us an opportunity to live in this great country. So just incredibly, incredibly grateful. Now, on that day, my family and I, we spent the day with close friends out on the island. We do a lot of boating, and so we live, right on the Gulf of Mexico, and spent the day out on the island, just making memories together and watching a multitude of spectacular fireworks displays. There's a island we go to when it's low tide. It's a pretty cool setup to where you got basically about 2 or 3 football fields size of a sandbar that kind of pops up at low tide. The kids can run around and play, and from that vantage point, you can essentially see and no less than a dozen different fireworks displays of all the different beach towns and cities that are within the Tampa Bay area. And so it was pretty amazing out there watching, again, no less than a dozen, probably upwards of 20 different fireworks displays that were going off, all within the same 30 minutes or 45 minutes. And so that was a lot of fun. Had a great time, just made a lot of memories, and overall it was just an amazing day. As far as a professional best, we're continuing to make offers, continuing to try to buy mobile home parks and other types of opportunities. However, we just had an LOI accepted on a 200-space mobile home park in Texas. This is a deal that we've been working on now for 6 months. Sometimes we work deals for a very long time before actually getting them tied up and moving forward with a purchase. So this one we've been working on for 6 months, and I'm excited to see that it's finally coming to fruition. Now, where this opportunity was derived, this one came from a cold call campaign, okay? As you guys know, we do a lot of direct mail and we do a lot of cold calling. This one came from our cold calling efforts. Now onto a few other items real quick before we get onto the show with Ian. Now, if this is the first time you're tuning into the show, guys, I just want to welcome you to this awesome family that we have here at the Real Estate Investing for Cash Flow podcast. And if you're one of the many millions of folks that tune in on a regular basis, I'm very grateful for you being here. And thank you for coming back week after week after week, because this show wouldn't be here if it wasn't for you. And like I do every week, I like to give a shout out to an awesome listener that's taken the time to go to iTunes and leave a rating and review. This one is from EMD Schmitz. It says, my husband and I have recently been tuning in, and we are loving the content. We are both new to real estate investing, but serious about building our knowledge. Kevin has great practical information on starting the process and features many seasoned experts in the industry. Thanks for getting us even more excited to jump into the game of commercial real estate. Well, thank you guys for leaving that review for me. That's awesome. This show really is founded on you, the listener, you guys getting tons of value out of what we bring to the show each and every week. And so I appreciate those that take the time to go and leave reviews and give me feedback as to how the show might be helping you in your real estate venture. And with that being said, guys, if you enjoy the content that we give here and you haven't taken the time to go leave the review, please do so. And I've got a free gift that I'm actually working on. It's going to be announced here in the coming weeks, something that we've been working on behind the scenes here. And I'm going to give this free gift to every single person that leaves a rating and review, both those that have already left one and then also any new ones that come down the pike. Okay, so you can be proactive about it. You can go ahead and leave that review and rating, and I'm going to make sure that everyone gets this amazing free gift. And I think you're going to absolutely love it. That's going to be the only way that you can get this free gift. Okay. And so with that, guys, I'm excited to get on to the show with Ian. So here we go. All right, guys, it's my honor to introduce my guest for today's show, real estate expert and vice president of investments at CrowdStreet, Ian Formigle. Ian, how you doing today, my friend?
I'm doing great, Kevin. Thanks for having me on the podcast. It's a pleasure to be here.
Thanks for joining us here. I know you're extremely busy. You guys got a lot of things going on there over at CrowdStreet. And so, for those folks that aren't familiar with CrowdStreet and more importantly, aren't familiar with yourself, Ian, maybe just take a few minutes, if you would, give us a little bit of a background of kind of who you are and ultimately how you ended up in the real estate space.
Sure, I'd be happy to. So my career is about 24 years long at this point, and it originated in the investment world. I've always been in investments at one form, but my first career was as a derivatives trader. I was a market maker on the floor of exchange in the United States. And so I made two-sided markets on equity options for about 6 years. And so what was interesting about that experience is I guess it gave me kind of an underlying fundamentals and building blocks and understanding risk. I think when I look back on it, I think I priced risk over 1 million times while I was on the floor. And you're in that rapid fire environment, taking calculated risks every day. And so that kind of set the stage for kind of more things leading to commercial real estate. So after a number of years on the floor, I spent a year or two trading off of the floor. And then, like many investors, my path to real estate was by starting just to do it on my own. I began purchasing single-family homes in California. This was in the early 2000 period, kind of in the Central Valley area near Sacramento. And so after a few years of doing that and got to the point where I wanted to move into multifamily investing, put together a model, suggested I should go where the data kind of told me where to go, not just where I thought I should go. And when I ran that analysis, it said I should be investing in Birmingham, Alabama. So I started multifamily investing there. Some friends and family money approached me at that point, and that began about 5 or 6 years of multifamily syndication in around the Southeast and Midwest markets. So after doing that for a number of years, that kind of would take me through the downturn period. So during the downturn, I was a multifamily operator. I had been acquiring, Class C and B garden style deals in the Alabamas and Texas, Oklahoma and Kentucky and the like. And so they were hanging in there. But as you know, capital really wasn't flowing during that period. And so I started to kind of contemplate my next thing. Am I going to still do deals or do something else? And it was really at that point that I was approached by the leader of a commercial real estate private equity shop in the town where I live, Portland, Oregon. And he recruited me to come join their group. They had about $1 billion portfolio. They had done, $3 to $4 billion worth at that time. And so he said, come join us. We're about to embark on, kind of getting back to it. And this is in the 2010 period. And so my point at that time was, well, I know multifamily, I know deals, but I don't really know office industrial retail, which was what this group focused on. And they said, don't worry, we'll teach you the ropes on those asset classes. So I joined that group, became a senior acquisitions officer there. Group here in Portland, like I said. And after about 4 years there and kind of becoming a leader within the deal team at that company, I was approached by the two co-founders of my current company, CrowdStreet. And so this is in the summer of 14. The platform had gotten live and the CEO was beginning to get venture capital traction and said, hey, we're looking for someone who's going to basically become our chief investment officer. And they would come out of a background that when they described it sounded like my background. And they said, well, let us know, if you know somebody. And I said, okay, I get it. It was that day I went home and told my wife that I had to go join these two guys at CrowdStreet, go build this platform. And they just hired a third guy to be the other key exec. And I said, with the four of us getting this thing going in the summer of 14, I think we had a shot. And so that was it. So I joined CrowdStreet and they had the second deal live on the platform. And since then, I've presided as the key decision maker on pretty much everything since, which is about another 330 deals. So here we are in 2019.
Alrighty, that's a great story. Lots happened in a short period of time. I'd like to back up because I like to set the foundation. I think you did that a good bit as far as you diving into the syndication side yourself with the multifamily properties in Birmingham. My question for you would be, how did your portfolio perform during the down period? 2008, 2009, 10. Ultimately, what did you see there? I mean, did you weather the storm just fine with those assets? And what would you have done differently?
Yeah, so overall, we hung in there. Some of the assets, a couple of the assets had a focus on a business model that made it challenging during the downturn. They were focused on the student housing market at the FAA Academy in Oklahoma City. So I would say what would we have done different was that would be on the low end of the spectrum. We were pretty focused on a niche market. And so we had exposure to that niche market. And if that niche market had some volatility in it, then we were going to suffer the brunt of that. So in that scenario, those two deals in Oklahoma City did amazingly well up and through, 2008, 2009 even. But heading into the end of 09 and 10, they brought supply to the market. They opened up the spigot basically for new student housing at the FAA Academy. And that caught us, that basically left us exposed. We were 100% FAA housing at that time. We had converted those properties from roughly 50% apartments and 50% student housing. So one thing I would definitely do different in that deal is I wouldn't have gone kind of all in. We got a little bit drunk on the FAA, Kool-Aid, so to speak. And because we were seeing our operating cap rates go up into 14 or 15, we were seeing 25 to 30% cash on cash. So it was intoxicating. So I think, that was a strong learning. It was an opportunity to learn from. Just because something is going better than you think it could go, well, maybe you should ask yourself what's going on there, because probably it's unsustainable. So if it wasn't going to be the downturn, it might have been something else. For a lot of the other multifamily deals, when the ones that were in Texas or Louisville, for example, those were B and C deals that were rented. They were hanging in there. And so what we saw in those scenarios is that, as I would say a lot of multifamily operators saw in that period of time, you can kind of throw rent growth out the window. You're going to probably offer some concessions to keep, and keep attracting people to your properties. You're going to, do whatever you can do to retain your residents and make them happy, but you can hunker down. And I think that's one of the interesting aspects of multifamily is that at the end of the day, people do need to live somewhere. And when these are apartments that are renting for $600, $700, $800 a month, there's going to be options for those people to move, but there's also switching costs involved. And so if you have a decent place to live, odds are that even in a downturn, you're going to continue to live there, but you're going to be looking for some additional incentives from the landlord to kind of keep you in place and keep you happy. So that was kind of what we saw, overall during the downturn.
Got it. I know that we're talking about multifamily here, but ultimately, CrowdStreet. Let's talk about CrowdStreet for a little bit here. And what assets are you guys specializing in today? I know that it's institutional grade commercial real estate, but what does that mean?
Yeah. So from a kind of a food group perspective, I mean, what we're seeing on the marketplace is all of the major food groups. So in addition to multifamily, which is still number one on the marketplace, about 40% of everything that we've ever done is multifamily. From there, the next step down is office and hospitality. Those are represented about 13% of total deal flow. And then from there, we're going to step down. So that's about roughly 2/3. The remaining 1/3 is comprised of everything else. Everything else being mobile home parks that, it's kind of deals that you do, medical office buildings, senior housing, self-storage. Really the only thing that we don't do on our marketplace is single family residential and raw land.
Got it. Okay. And give me an idea of what the structure looks like. So for the folks that are listening, I mean, I know that you've got individual deal sponsors that you guys vet that ultimately you utilize your platform to market their opportunities, but what does that process look like behind the scenes as far as the deals that make it up onto your platform? What goes into that?
Sure. It's a pretty involved process. And if you think about it from a funnel perspective, for every 100 potential deals that kind of show up on our doorstep, 5 of them actually make it onto the marketplace. And how that begins is as follows. So out there in the country, we have employees of the company that are in all of our key markets. They're going to be in the Atlantas, the Washington, D.C.s, Chicago, Denver, Dallas, Southern California, and so on. And so those are representatives of the company those are people that know deals. They might not know them to the level of the investments team. Maybe they're not investment professionals, but come out of maybe capital markets backgrounds. And so, but they have in-place relationships in those markets, and they're the people that are kind of bringing in deal flow every day, getting meetings, getting to the best stuff, and then, kind of culling through their own pipeline to then elevate the best deals that they know that are eligible fits for the marketplace. So that's one key aspect. The other thing that we also do is we have, a blend of also inbound, outbound traffic. I mean, we have deals we're a public marketplace with a website. So as you can imagine, we get flooded with deals every day. A lot of that is, there's a lot of noise in that channel, but we do sift through it and we do find eligible deal flow from time to time. Another thing that we do constantly is, we are participants in the commercial real estate industry. We're members of organizations such as I'm a member of the Urban Land Institute. So we're sourcing deal flow through that organization, also through all the, the typical conferences. For example, a number of members of our team were at the ICSC Recon Conference. That's one of the biggest real estate conferences in the world. We had 5 people there, a couple months ago, and have some great retail deal flow coming out of it. So that's going to be, from that funnel perspective, everything coming in and kind of hitting hitting the investments team. Well, the 100 is really going to drop down to about 40 by the time that anybody on my direct deal team is really even aware of the deal. And then from there is where a lot of the hard work is going to begin, because then we're going to have to go through an analysis of the sponsor, the opportunity, and the structure of that opportunity. So really, it is really those 3 steps. So we begin with the sponsor evaluation. Sponsors submit applications. We basically have to go through a due diligence and background check process on them. We're really looking for, and it's a combination of things. Yes, they have to be eligible and they have to be a good operator and they have to be in good stead, but they also have to essentially understand the nuances of what it is to go onto a public marketplace and go direct to investor and raise capital online. So we're looking for both eligibility plus good fit. From there, so for those sponsors that make it forward, now we're really going to spend time looking at the deal. And we're going to look at the deal like we would look at the deal. The people on the deal team have come out of real estate private equity acquisition backgrounds for the most part. So we're going to look at it like we would acquire any deal. A lot of us have actually done deals with institutional capital partners. So we understand what it is like to get kind of grilled, run through the process of really what those institutional those capital partners are really looking for and what they're asking us. So we're going to ask some of those same types of questions. We're going to probably do it in a little bit more of a collaborative format, but we're really going to get to the crux of, is this a good deal? Does this deal make sense? Do we think it has, a valid and kind of executable business plan? That's going to entail an analysis of everything that they've got, the models, the documents, third-party reports. I mean, you name it. I mean, for anyone who's done deals out there, you know what that process looks like. And so from there, that's the second key step. So from there, the third key step is really to evaluate the structure of the offering. For example, we're talking, what are the preferred returns and the splits? What are the key provisions of the operating agreements, right? What do investors have the rights to do or not do? And now that we're a marketplace that's over 5 years old, that has now had about 330 offerings on it, about $12 billion worth of real estate that's come to the platform over that time period, with now thousands of investors that have invested, we know exactly kind of what the investors are looking for. We also know what we're looking for as a platform. So what we're really looking for in that third step is, are the terms structured, reasonably? And if they are, then the deal is approved and it can become eligible to go on the marketplace. If there's something that's a little bit out of the norm, we're going to have that conversation with the sponsor. More often than not, that leads to some adjustments in the structure. We have an in-house counsel. She comes out of a decade of securities law experience. And so she's the one who's going to be kind of on the front lines having those final conversations. Sometimes a deal dies at that point. If we find something that is essentially untenable for us and we raise that, and then the sponsor says, I understand that it's untenable for you, but it is how I conduct business, maybe that's a point where the deal dies. So throughout that whole process, that's how that 100 gets down to about 5 that actually make it onto the marketplace.
Got it. No, I appreciate that. What are some of the big value, or what is the big value proposition from for a sponsor that might have a good track record, right? You guys look for folks that have a track record, that have been in the business for a period of time, that are good operators. That means they've been there, they've done that before, right? They've probably raised capital, they've done a few different syndications. What value does CrowdStreet bring to that individual that has access to capital already? Is it a situation where they might not be able to raise, they've kind of tapped themselves out from their existing equity sources and they need to put it out there in the marketplace. I mean, give me an idea what that looks like as far as the value proposition.
Absolutely. So, I mean, and Kevin, it's definitely a relevant point I say relevant is the word. If we're going to be in a deal, there has to be relevancy there, right? Nobody's doing this for fun. Investors aren't doing it for fun. Sponsors aren't doing it just for fun. We're doing it because there's a product market fit between a sponsor and investor at the end of the day. And so from the sponsor perspective, how we are going through the education process with those sponsors is a couple of things. First, and really what it boils down to is it's an expandable capital for sponsors. Sponsors will come to us, and this is actually one of the key kind of determinants of do we want to continue to talk to that sponsor is they have to have an ability to raise capital through other channels. Because we are an online best efforts channel at the end of the day. We have a lot of track record behind us and we have a lot of data that supports that. But we don't know in any given instance what the exact amount of capital that we're going to provide for an exact deal because we're not issuing term sheets, right? We're exposing them to an online source of capital. So ability to do deals is fundamental to like the criteria. And the way that what we see from the sponsor perspective is when it most resonates, it's resonating through a number of ways. The first and kind of the biggest way is that it's giving them access to an entirely new set of investor base that essentially kind of it blows up their ability to do deals to the next level. They'll come to us for example, with a scenario to say, if I don't know CrowdStreet, maybe I'm doing 4 deals this year. Now that I know CrowdStreet, I'm easily doing 6. And I don't know exactly how all the chips are going to kind of, flush out at the end of the day, but I know that I have the capacity to do more deals now because I have essentially a newfound investor base that can get bolted onto my own. The other thing that I would say from the perspective of the sponsor is that this kind of goes down to, I think there's kind of like 3, if you think about it from a stool perspective, there's 3 legs to the stool, and I think on it, which sits the holy grail of capitalization. And so it is control, number 1, pricing, number 2, and execution, number 3. So, and if you look at our history, the things that we've always offered to sponsors from a capital market solution perspective is pricing's always been fair. We're leveraging online to gain scalability, and that's driving prices down. So we're cheaper than some alternative sources of capital. Control, well, that's something that the sponsor always gets. And that's something that's definitely I think in some cases, very powerful for the sponsor. They're the ones who've out there, they're sourcing the deal, they're finding it, they're negotiating it, they're putting it under a contract, and they're about to buy it and execute the business plan. Those sponsors most of them actually have the ability to go get institutional capital, but they also know that with that institutional capital comes almost to ceding most of the control over to that capital partner. The minute that one party writes 90% of the check, they're going to call the shots. Do we buy it? How do we buy it? How do we operate it? When do we sell it? And so what we're seeing is from the operator perspective is saying, I want to have a better control over my own destiny. And I want to work with investors that want to work with me for the long haul, not necessarily just an investor who wants to work with me on this one deal and then repeat that same process over and over again. So that's the key thing. And then, the third is the certainty of execution. Now, I would say that over the course of our history for the first 3-4 years, certainty of execution has been honestly our Achilles heel. Now, what's changed in the last year is that we've now hit this big inflection point and we're scaling faster and we're seeing the ability to now raise large amounts of capital very quickly to the point where now we've raised $15 million in 10 hours. We raised actually the other day $5 million in 2 minutes. So when you start to have that kind of capital velocity, the certainty of execution starts to go away. And so that's where we feel like we sit in a pretty good spot because now really the third leg of that stool is showing up.
Got it. No, that's great. I appreciate the insight there. What does that communication bridge look like between the investor and the sponsor once they both come into your funnel? I mean, is it you're just the connecting point, and then ultimately the conversation or communication moves on to between the investor and that sponsor directly, or is CrowdStreet still involved at that point in time?
So we will stay involved throughout the life cycle of the deal from an infrastructure and kind of a relationship management perspective on both sides. So for the sponsor is going to utilize our technology to report directly to the investors through what are called investor rooms. And they're going to upload the quarterly reports, issue the K1s, distribution information and the like. The investor, for example, is now, starting to amass a portfolio of online investments. So about 60% of all investors are repeat investors. The average repeat investor has 5 investments on the marketplace. So as you can imagine, this is becoming a little bit of the Amazon effect for them to say, this is where I come to do my online commercial real estate investing. I want to gather all the information in one place. So what we do is we give the investors good tools to analyze and track their portfolio from their own dashboard. And so that's what the investor is looking for. And so from that perspective, then so we are the communication infrastructure. And then we have teams of, so there's services that are involved on both sides of that to make sure that investors always know what's going on, that we're still there with them. And then conversely, for the sponsors, we're still with them side by side. They're still utilizing our technology. Just because we raised capital with them 2 years ago on a given offering doesn't mean that we're still right with them today.
Got it. What kind of, as far as like long-term projections, are there any particular, on the underwriting side, are there any particular sensitivity controls that you guys have been putting in place, more importantly today than maybe the years past, just knowing that the inevitable, correction or downturn might occur here in the next coming years? And I know it's all market specific. So like it's a tough question to answer because real estate is local, right? And every asset class responds to a correction or a downturn differently than the next. And so with that being said, are there any precautionary approaches you guys are taking with your business and the vetting of the sponsors, the vetting of the deals, for that inevitable correction that might occur?
Sure. So we're taking a lot, but what I'll touch on just a few of kind of the most salient ones. So for starters, the way we look at it is that, at the end of the day, you are investing with an operator. And so we put a lot of strength of kind of the analysis into that. Cycle in, cycle out now, we're thinking who are going to be the best and brightest sponsors out there, who has the ability to weather a storm. Because when you're investing with a group, this isn't just like investing in a public, stock, for example. This is with a group and groups out there have different abilities to execute when times get tough. So we're putting a lot more stringent kind of scrutiny on to who is the sponsor. Does the sponsor have a really good track record? And do they have the wherewithal to kind of see assets through a downturn? We know a downturn is somewhere out there in the future. Nobody knows when, but we know that, this cycle is not going to continue on for another 40 years, for example. So we can all agree on that. So I think that's where the analysis begins. So more and more scrutiny on who the operating group is coming to the platform. These days, we're finding that the typical sponsor on the marketplace has, started to on average do over $1 billion worth of deals, has been in multiple markets and has, 10 plus years of operating experience at the entity level. So those are just good. If you know that a group's been doing that, they've been through a downturn before. And if they've been through the last downturn, there's a pretty good chance, and they survived that, there's a pretty good chance they're going to survive the next one. Because, I think we all hope that the next one isn't going to look anywhere near like the last one. So that's number one.
Yeah, no, I appreciate that. I hope it doesn't look like the last one. With that being said, you guys are looking at a ton of different deals, different asset classes, and in many different markets across the country. Are there any signs that you're seeing, or any patterns or trends that are starting to play out in different select markets or within different asset classes that might say that correction could be on the horizon? Again, not in a broad brush approach, but just, from a more niche level, market specific or asset specific.
Yeah, what we see out there right now doesn't necessarily lead me to believe that the cycle is ending. What it leads me to believe is that the cycle is the expectations are flattening, I think is the other thing. So, and also I will also say that, vis-a-vis the last cycle, some of what gives me reasonable optimism that whatever the end of this cycle is will not look like the last cycle is that there's far more rational behavior today than there was in 2007, right? We all know what we saw. The groups who were active in 2007, you saw this two-sided market where the buyers were just eager to pay anything to get access to an asset. They were throwing out ridiculous numbers. The assumptions in the underwriting were everything had to occur that nothing had occurred before. And so when every assumption is like, well, as long as it all gets better than the history of the world, we're going to have a good deal. Meanwhile, you had the sellers looking at the assumptions that the buyers were making to get to those valuations, knowing that there was no chance that they felt that they could replicate what the buyer thought they could do. And so they said, look, if I can't get anywhere near what you're assuming, I should probably just give you the asset and give you a chance to take it. So hence we saw that huge spike in volume in 2007 led to the downturn in 8 and 9. So, but today, we're seeing a different, equation. We're seeing sellers that have sustainable demand for their properties. They're seeing the ability to move rents and occupancies are still tight. Hence, my asset's going pretty well. And so therefore, I'm not super eager just to throw it away, but I'll give it to you if you pay me a fair value. Now, on the flip side of that market, you're seeing the buyers telling the sellers to say, look, we're 10 years into a bull market here. I can't necessarily think that what's going to continue to happen, has happened, will continue to happen. Here's my underwriting, and here's why you have to give me the asset at my price. And that's creating a bid-ask spread. So we've actually seen volumes of transactions go down in the last couple of years. And to me, that basically boils down to there's some rationality in the market right now that gives me overall some, like I said, cautious optimism that I think things are still, I think we've got 2 or 3 years of something that's not bad in the future. I don't know anything beyond, I don't know if anybody knows beyond that. But right now, sure, we could have an event-driven type of market ending, like a lot of times happens, and absent some sort of major event that comes out of left field, I think you're still seeing low unemployment. We're seeing wage growth. We're seeing, migration movements, creating demand for real estate. I mean, really, that's what it all boils down to the days. If there's still fundamental demand drivers, I think there's still a deal.
Yeah, no, absolutely. I feel like we have that broken record playing in our office, or at least we have for like the last 6 months, as far as the expectations of sellers versus what we're willing to pay on the buyer side. And just we're very conservative as far as our investments are concerned. And there's a pretty big delta there, it seems, and it keeps growing in size. And hopefully that will come back to a much more minimal size gap here in the near future. But in any of our volume, acquisition volume has definitely shrunk over the past, I'd say 10 to 12 months, where it's like truly significant in size. So with that being said, one of the things I meant to ask earlier, Ian, is as far as the type of investments that are offered on the platform, is it strictly equity or do you offer debt instruments as well?
So the answer is we do offer both, but well over 80% of everything that is on the marketplace is a common equity position. We would say joint venture equity in the business. And so, typically speaking, it's going to be a 2-stack, 2 components of the capital stack, senior debt, on average about 67% loan to cost of the asset, whether it's a development or it's an acquisition. And then that remaining, 33% is the equity. And so that's the most typical scenario where we're going to come in, is it's giving that equity investment opportunity to the investor. With that said, now the other 20-ish% is a blend of either preferred equity. So we've had a number of those. We actually had one on the platform just recently that just went off. The preferred equity is going to obviously sit right on top of the senior debt. It's going to be in priority position to the common equity. If we're doing a preferred equity offering, somebody else is bringing the common equity. It's not our platform. So we'll see those from time to time. And then the other scenario that we have seen, which is a little bit more anecdotal because of the structure of our marketplace, is a mezzanine debt position. We've never done senior debt on the platform, but we've had both debt funds and we've had single asset debt offerings in a second position. And the reason I mentioned the structure of our marketplace is because we are a direct to investor platform, we would, if the investor was going to invest into debt, well, sometimes you say, well, who's the lender, right? Because we'd be capitalizing a loan. So for a debt offering to appear on our marketplace, that investor is investing with the originator. CrowdStreet does not originate debt, right? We are a marketplace. So there are groups that are either structured as a debt fund or they have an originations platform. And some of those groups have come to the platform and raised debt, capital for debt offerings.
Got it. That makes sense. Thanks for clarifying that. I didn't even think of that before I asked the question. What's the future of crowdfunding look like? I mean, it's such a young industry still, and there's lots of room to grow, and it's really disrupting the entirety of the real estate space. I mean, and many other industries as well. And so what do you foresee the next 5-10 years bringing as positive change as a result of crowdfunding?
Sure. So I think 2019 is a very interesting year for this. It's still an infant in this industry in its infancy, in that, we've had the first kind of major shakeout. And there's been for example, I want to say we hit a high mark about 2016. There were like 120 platforms out there, and they're trying to do everything, every asset class, every specialty. I mean, you name it. There was a platform that was trying to do it. We've seen that number dwindle now significantly. And we've seen the kind of quote unquote winners now emerge. Luckily, we sit in one of those, winning spots. It's still a huge market, and there can be multiple winners in the space. That was one thing that we fundamentally believed in when we got going in 2014. But now what we're seeing is that a handful of platforms have kind of come out. They're starting to feel like they're coming out on top. And with that now, and with a market, I mean, we are over 5 years into our marketplace. What we're seeing now is just that kind of that next level of maturation and adoption. And so there's an interesting statistic that I think kind of tells the story of even us, but then the overall industry, in that it took us just under 5 years, so April of 2014 to March of 2019, to reach $500 million funded, closed and funded through the marketplace across every offering that's ever showed up. In 2019, we are on track for calendar year 2018 to exceed 500 million funded.
Wow.
So, right, 1 year will now exceed what the previous 5 did. And so I think that's the telling sign, is that we're now starting to see the adoption at the next level. We're starting to understand that investors that are coming didn't necessarily they weren't even thinking about this 2 years ago. I mean, there was definitely that first wave, that first 2 to 3 years. That was the early adopter phase. Those investors are still very active today, but we're seeing it's opening up to the next level of investors. And those investors who are coming, it's really interesting because they know and have heard that alternative investments, and we obviously know that CRE within alternative investments is the largest asset class. It's actually the third largest asset class in the world if you remove cash from the equation. And so we're seeing this overall transformation of understanding to say, I understand that alternative investments are really good for a diversified portfolio. I know that CRE and CRE private equity has been delivering outsized returns since the 1980s. I realize now that I hadn't gotten access to these investments before, but that things like the Jobs Act are starting to give me access to it. And I'm here and I want to understand, I want to learn, and I ultimately want to invest. And so that's kind of the really exciting and fun part, because now we're just at I think the tip of the iceberg of that next wave. And we can see how that next wave is going to lead towards the onboarding of now hundreds of thousands of investors over the ensuing years. And so to answer your question, Kevin, in terms of where does this go in 5 years, I think there's a lot of correlation to what you saw in e-commerce. And so a couple of years ago, we were still in that 1994, 1995 phase of e-commerce. It just showed up. It was just possible, and people were just trying to understand what it was. Now I would say that today is more akin to the late 90s of e-commerce. But now where I think it can go is it can start to look like e-commerce in the early 2000s. And that's where we started to see a huge growth in a lot of platforms. And so I'm optimistic and kind of bullish on the future and look forward to a day when we've got hundreds of thousands of investors, jumping into deal flow, and we've got the ability to go out and bring billions of dollars of really quality deal flow to those investors.
Mm-hmm. No, that's wonderful. What is the minimum investment size? Is it 50,000? For the
25,000.
25,000. Okay, got it. Accredited only, correct?
It is accredited today, correct.
Okay, got it. So Ian, on your website, it looks like there's 3 different paths of how an investor that's coming into the fray can invest through the CrowdStreet platform. I think one was direct investing, another being fund investing, and the last being managed investing. Can you speak to each one of those and ultimately what that means?
Absolutely. So if we think about the 3 different ways to invest through the marketplace, so I'll take them from kind of like top, most common to now least common, but changing a little bit. So for starters, the most common way that investors continue to invest today is by joining the marketplace and beginning to invest in a single asset offering. It is what we call that's the self-serve user marketplace. They're joining, they're looking for investments that fit their particular criteria. They're the decision maker behind, is it a right fit or not? And then they're investing at a minimum of $25,000. And so that is still the bellwether of the marketplace. Now, in 2019, there's two additional paths to investment that are seeing rapid growth. The first of which of those two is our blended portfolio strategy. So the CrowdStreet blended portfolio is in essence an indexed style fund. It's driven by an algorithm, and it is intended to be a passive way to get to a blended portfolio of 30 to 50 marketplace offerings over a roughly 12-month period of investment. So we open that every quarter and then we close it. We have actually had 3. We're on our 3rd series right now. Our 4th one will debut next month. And so that's a way for, and really what that was born out of was investors coming to the marketplace, joining, and then telling us that they really love the platform, but they didn't know where to start and they didn't know where to pick and choose. And they're saying things like, I don't know about this multifamily deal versus this retail deal versus this office deal. And there's a lot of nomenclature here. There's a lot of jargon. So, and I'm a little bit trepidatious about where to dive in. So the blended portfolio is designed to say, if you don't want to try to like quote unquote beat the market, just buy the index. And the index is driven by, it has a thoughtfully built algorithm that is going to blend across asset type, across sponsor, across geo, you name it. And it's going to create kind of a perfect blend of these 30 to 50 offerings. And, if you like the platform, you're basically buying the best of the platform. So that's the second way. The third way is the privately managed accounts. Now, where that solution was born out of was a number of our larger investors over the years who came to us and would say things like, I really like the CrowdStreet marketplace. You've now seen that I've invested multiple millions of dollars over the past few years. I want to invest more, but I want your advice. I want you to tell me about what you think, and I want you to look at my portfolio and tell me which deals you think are best to help me build a diversified portfolio. So what they were really asking us is to create real estate advisory services. And so after seeing that pattern emerge over a couple of years, we determined that 2018, we reached the tipping point. So in the fall of 2018, we launched a registered investment advisor called CrowdStreet Investments. And now we offer a privately managed account solution to those investors who say, if you want to open an account at a minimum of $250,000, you will get a portfolio manager, you will get an advisor, and we will custom build a portfolio that's optimized for you. And actually, what we do use in that case is some of the model that we've actually built our blended portfolio on. They actually get like a customized version of that model. And then we say, well, what we do is we dial in the assumptions based upon the investment policy statement, and that becomes almost your blended model. You're investing at the minimum increment. We're going to get you between 15 and 20 offerings over the course of the next year. And now we can have a direct conversation, for example, like they might say, for example, I love multifamily. I also like office. Maybe I don't want retail. Maybe I don't want hospitality. So now you can kind of dial in and be more specific to it in the individual investor's kind of criteria. So those are the 3 ways. And like I said, the other 2 ways, so the blended portfolio and the PMAs are relatively new, but they are growing rapidly.
Has that been well received, the managed investing?
Yes, very well received. Some have said what's both interesting is that in both the blended portfolio and the PMA strategies, we've had investors literally tell us, this is what I was waiting for me to become active. So thank you.
Fantastic. I mean, it goes to show that you definitely have to survey your clients, your customers, right? I mean, which you guys have done, and you've taken that as the gospel and made a solution for it. So I love that. As far as the cost of an investor, I mean, where does CrowdStreet make its money? Where's that slice come out of? And ultimately, does that come from both sides, both the sponsor and the investor?
Yeah. So I'll walk you through it. So there's really kind of 3 ways that CrowdStreet makes money today in no particular order. So the first, well, let's say from a revenue perspective, actually, the number one way is that sponsors pay CrowdStreet fees to gain access to the marketplace. And like I said, that kind of goes to that cost scenario. That there is always a cost of raising capital in the commercial real estate world, typically. I mean, some sponsors have maybe built an organic base over the years, and that can be the lower cost, but there's marketing costs to get there. So that's the number one ways. Sponsors pay fees, they get on the CrowdStreet marketplace, and they pay fees for coming and executing on the marketplace. The second way that we make money is actually something that maybe a lot of investors don't really understand, but is definitely a piece of the CrowdStreet platform, is that we are a software as a service company. We have about 180, maybe 190 companies now that license software from CrowdStreet to run their own private marketplace. And that was born out of us in 2014 asking these sponsors, hey, I see you have a portal. What's on the other side? And they would say something like nothing, or a glorified Dropbox that's kind of broken. And so what we realized was that the commercial real estate industry was somewhat latent to adopt technology, that they knew that coming into 2015, they needed to have something, they needed an online solution, in essence, something better than email and spreadsheets to communicate with investors. And so what we saw the opportunity was, they said, well, we're building a massive, investor management infrastructure platform for conducting real estate offerings online. So if we can do that for CrowdStreet, we can do it for any operating company. So we created a white label version of our software that we began licensing to companies in 2015. So that now has a substantial revenue component to it. And then the third way is, now that we do have the blended portfolio strategy and the PMAs, that's where individual investors would pay CrowdStreet money. They're either going to pay something like about a 1% asset management fee in the blended portfolio. In the PMA side, they might pay 2 to 2.5% in the year of deployment of the capital of the PMA account. And then it's going to trend down very rapidly to something like 25 basis points for the holding period. And then again, a couple points for when they make follow-on investments. So those are the three ways that CrowdStreet gets paid money.
And I can tell you that we use IMS today. We did look at CrowdStreet and a number of other platforms a few years back. And I think we just recently in the last year looked at CrowdStreet, looked at you guys again. You guys have grown by leaps and bounds on the white label side. And ultimately, I think we're kicking ourselves in the butt that we didn't go with you guys 2 years ago. So
there's three good solutions out there. I mean, we're one of the three, but I think there's two other viable solutions as well.
Yeah, fantastic. Well, Ian, I don't have anything else unless you think there's something that we might have missed here. This has been an absolute pleasure having you here on the show, and lots of golden nuggets were shared. And what I'd like to ask of you, if you had this one final golden nugget of advice or wisdom that you could leave with our listeners today that might inspire and motivate them as they progress in their very own real estate investing career, what would that one last golden nugget be?
I think the nugget I would leave investors with is to take a hard look at asset allocation models. I'm a big proponent of kind of the modern portfolio theory, approach to investing. And that, and this is kind of goes back to one of the core tenets of why did we build this marketplace? And is that we had a fundamental belief that investors should have commercial real estate in their portfolio. It is how pensions invest. It is how family offices invest. It is how the most sophisticated investors in the world, even in, like I said, either the pensions, the institutions, and family offices of the world. I mean, look across that. The allocation ranges are going to start at high single digit and go as high as 30 or 40 or 50%, particularly for someone like a family office. And so I think the takeaway is, if you look at your portfolio and there isn't commercial real estate in it, it's really time to take a hard look at why not. And I would understand that a decade ago, there were a lot of good reasons that wasn't the case. But there's lots of solutions out there. CrowdStreet Marketplace is just one of them to say that a new day is here. The ability for the individual investor to get access to institutional quality commercial real estate is now in place. And that asset class has a place in every investor's portfolio.
Yeah, no, it's so true, so true. Ian, I really appreciate you coming here on the show. And folks, if you'd like to learn more about Ian and CrowdStreet and the services that they offer, you can go visit them at crowdstreet.com. And Ian, thank you. And I just want to thank everyone else that's listening here for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bupp, signing off.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.